Hi everyone, welcome back to Corporate Decoder, the place where we decode all the corporate news. Today we are diving into a report that might sound as exciting as watching paint dry, but stick with me, because we will see which company's shares are as valuable as the paint on the wall. In this video we will look at an 8K filing from Procaccianti Hotel REIT, and let's get straight to the point how this company has determined the value of its shares. Before we start, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where you can discuss this and other reports with fellow followers. So there is some standard information here, such as the legalities that ensure it meets SEC standards. The important date we need to keep in mind is June 25, 2025, which is when this report was filed, as well as the date of the event reported. This report is called an 8K, which companies use to announce big news such as important events. The report starts off by talking about a press release where they announce the estimated value per share of common stock. It is worth mentioning that this press release and the information in it is not officially filed under the Securities Exchange Act. I am mentioning this as this becomes important later. This section dives directly into how they figured out the value or net asset value AV of each share. This happened because the company needed to give those NAV numbers to brokers to help them with what they are obligated to tell their customers. This was done using guidelines that the Institute for Portfolio Alternatives IPA put out back in 2013, as well as advice from the SEC or Securities and Exchange Commission. The company thinks nothing changed between the day these numbers were calculated, which was in March, and when they released this filing to make them need to recalculate these numbers were calculated, which was in March. And when they released this filing to make them need to recalculate these numbers were calculated, which was in March, and when they released this filing to make them need to recalculate these numbers were calculated, which was in March, and when they released this filing to make them need to recalculate these numbers were calculated, which was in March, and when they released this filing to make them need to recalculate these numbers were calculated, which was in March. The audit committee, which has independent directors, looked over the whole process of figuring out the value. They checked the methods used to decide each share's value, made sure they followed real estate industry standards, and checked that the assumptions made were reasonable. After talking with their advisor and an independent firm named Robert A. Stanger & Co., they came up with these values. Stanger looked at 5 properties the company owns. They created reports that gave important information and assumptions and calculated the value of each property. Stanger also made another end report. This end report estimated the net asset value per share of their KI shares, K shares, A shares, and B shares. These reports use the values of the 5 properties, Stanger's estimate of the company's debts, the advisor's estimate of other assets and debts. After taking in all of this, the board eventually decided on the values, which were 10.17 per KI share, 10.7 per K share, 7.4 per A share, and 0 per B share, all calculated as of March 31, 2025. Now let's dive into the financial numbers. The table breaks down how they calculated the net asset value, or NAV, per share for different classes of stock. It's like figuring out how much each slice of a pizza is worth, depending on who gets the toppings first. Looking at the KI shares as of March 13, which hasn't changed since last year. Now shifting over to the A shares, we see a NAV per share of $2 from the 14, a drop from the previous amount of 9.82 cents. Which now let's dive in 20 cents, which are dollars, but at 14.12025. The NAV per share is $10.17, which hasn't changed, which hasn't changed, which hasn't changed, and which hasn't changed, which hasn't changed from 7 last year. Now shifting over to the A shares, we see a NAV per share of $7.14. A drop from the previous amount of 9.82 cents. With the B shares, they show as $0.00 per share for both years, which looks bad and may indicate they have no claim on assets after debts and other obligations are settled. How they figure out each share is quite complicated. First, they account for what is owed on the KIK and KT shares. Then they look at any unpaid fees to their advisor. After that is the A shares for their initial value plus any unpaid distributions. What is left after all of this is split, with half going to KI, KT and K shares, 1.5% going to B shares and 37.55% going to B shares and 37.5% 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 going to B shares and 37.55% going to B shares. The company makes it clear that figuring out the NAV is really about making reasonable estimates. There are no hard rules about what methods you have to use, so they aim for what seems fair and supportable. They highlight that these numbers can change, as anyone using different assumptions could come up with different values, which could be significantly different. They are also not audited and do not represent a liquidation value, meaning it's not what you might get if they sold everything today and paid off all debts. Stanger, the company that did the evaluation, was picked because they are in the business of valuing real estate properties and are not related to the company or the advisor. They say that the reports were performed in compliance with industry standards. In making their reports, Stanger took into account information that they believe was relevant in valuing the company's real estate properties. Stanger was paid a fee to do the appraisal and create the NAV reports, and they agreed to protect Stanger against any liabilities coming from this agreement. Stanger also made many assumptions, such as that the company has clear title to each real estate property, no title defects exist, any improvements were made correctly, there are no hazardous materials, no significant deed restrictions, and no changes to zoning ordinances. The prices the company might actually get for their properties could be different from Stanger's analysis. Stanger is actively engaged in the business of valuing commercial real estate properties, similar to those owned by the company, regarding public security offerings, business combinations, and similar transactions. The company says they do not believe any conflicts of interest are present between Stanger, the company, the advisor, and their affiliates. Because of inflation, interest rates, Russia and Ukraine, and the Middle East, there is much risk in the current markets. Stanger is not responsible for those things it cannot foresee. Inflation is expected to disturb the markets, which have a potential impact on things such as discount rates, capitalization rates, and interest rates. In coming up with the property's value, Stanger did a bunch of things. They spoke with company officers or advisors, looked at historical statements, revenue, tax information, and looked at what the acquisition criteria and parameters were that real estate investors used for similar properties. To value the properties, Stanger used the income approach and sales comparison approach. The income approach says a property's value depends on how well it produces income, and the sales comparison approach uses sales of similar properties to estimate value. Stanger summarized inputs and assumptions and gave a value for each of the appraised properties using financial information given by the company and the advisor. As of March 31, 2025, the company has invested $8 million in capital improvements on their real estate, bringing the total value to $109.1 million. This is around an 11.80% for the terminal, 25% for the terminal capitalization rate, 10.25% to 10.75% for the terminal capitalization rate. Went down by 25 basis points. The appraised values would increase by $1,660,000, $60,000, $20,000, $60,000, 125 capitalization rate, 10.25% for the terminal capitalization rate. Went down by 25 basis points. The appraised values would increase by $1,660,000. When valuing the debt, their consolidated secured notes payable, Stanger estimated them using a DCF analysis, which is discounted cash flow. This used data based on the loan terms and current market interest rates for notes with similar factors, such as remaining loan term, value ratios, debt ratios, prepayment terms, and property characteristics. Current market rates range from 4.32% to 6.75% for the secured notes payable. As of March of 2025, Stanger estimated the fair value of the company's secured notes payable to be $64.8 million. The weighted average discount rate applied to the future debt payments was around 5.94%. Fluctuations in assumptions such as the market's interest rate of secured notes payable would change these estimates. For example, if the market interest rate decreased by 25 basis points, it would decrease the fair market value by $285,037 payable would change these estimates. For example, if the market interest rate decreased by 25 basis points, it would decrease the fair market value by $285,737. The value of the company's cash, assets, and liabilities were estimated by the advisor to be close to the value as of the valuation date. They say that the carrying value of most of their assets and debts are equal to their fair value, mainly because of short maturities. The estimated per share NAV was calculated with the K-share threshold net of distributions from when the company first started through the valuation date. The company is saying the numbers are estimates. The company cannot promise that a stockholder would be able to resell their shares at the K share estimated per share EVs. The board decided that starting on the date of the next distribution reinvestment plan offering, the offering price of K shares will be 9.666 per KI share. What this means is if you have enrolled in the DRAP program, you will acquire more shares automatically at this rate. The share repurchase program says that the price for shares repurchased will be a percentage of the most recent estimated per share NAVs. The company says the board has determined that the estimates of K shares and KI shares from 2025 will be the recent estimate for these shares starting June 25th, 2025. The board has authorized the company to agree to renew the amended and restated advisory agreement. The agreement will be renewed for another year starting on August 20,000, 2025. The company states that some of the points in this report may be forward-looking statements. These statements are estimates related to companies' expectations regarding business performance and the estimates of what the per share EVs will be. Some statements here are regarding market volatility and global trade, as well as how current wars are factoring into it. Now for my quick take on the company. It looks like the value of the A shares may be decreasing as they dipped from 9.82 to 7.1. It's important to remember it's just an estimate and can change over time based on events involving the real estate market, such as interest rate and inflation. Alright, that is our overview of Procaccianti Hotel REIT latest filing. What is your take on these numbers and what they mean for the company's future? Drop your thoughts in the comments below. If this analysis was helpful to you, hitting that like button really helps us, and subscribe for more. Don't forget to check out our Discord in the description for you to join our community. Thanks for watching. See you next time.